on recorded the cloud.
Okay, I did, and it just went. It did nothing. I don't see any change. Oh, there's, yeah, it says pause recording. I'm wondering if
That's
I'm
what
doing
you're now recording. That's what I wanted, because I'm going to stop my recording. I have to go right now.
Oh, is there a way to merge these two later?
Yeah.
Oh, okay. All right, so I'm going to put the recording again. Looks like we're recording again. Okay, so we're going to get started again, okay? Okay, so we spent a whole bunch of time today talking about cost basis. This is a concept that is really, really critical. Cost basis is so important because you need it to talk about depreciation, which is coming next today, and then we need it to talk about sales. And we're going to tie it in. I've tried to tie it in a little bit as we went along today, just now, but we need to tie it in some more, okay? All right. So what I want to do is this. Give me just a moment, guys. I'm getting things ready here on my end so I can see everyone again. There we go. All right. Okay, so we've talked about cost basis. Now we're going to talk about depreciation. So depreciation is only used for business activity or income producing activity, okay? So business and income producing activity. So when you're running a business, whether it's your own personal business as a self-employed person or you're running a big corporation, it's the same thing for depreciation purposes. It's still a business, okay? So it's used for property that's business property. There is one exception to that, and that is personal property that's not business related, but you've got it for investment. What might be a good example of non-business income producing activity? That's, in other words, is something you've got for income producing that's not really a business. Can somebody just throw out some examples that you can think of?
Rental property?
Rental property, sure. Yeah. You know, that's not really a business. That's not how you make your living, but you have an investment property and you're making some money off of it. Any other examples you can think of?
A tractor?
I'm sorry. I'm not sure I heard that right.
So you want something that's used only for business, right?
Well, that's business property. I'm asking about income producing property. What would income producing property include that's not necessarily business property?
Like a tractor or something?
Well, a tractor, look, you know, anything is possible, but normally when I think tractor, I'm thinking somebody's running a farm and that's a business. You know what I mean?
Racehorse.
Okay, a racehorse might be. You know, if that's not your main business, it's just an investment because racehorses are more expensive than my house. So,
that's true.
Yeah. But another thing might be if you invest in coins, you're a coin collector. You know, that's not your business. That's not a business. And that's also not the way you make your main money, but it is income producing activity. Okay. Does that kind of make sense what the difference is? One is actually a business. Another one's just you're kind of investing in something to bring a little income in, but it's not a business really you're running. Okay. So there are two ways to subtract business expenses from business income. So right now we're talking about business income and business expenses. So when you have business income, you also normally will have expenses that go with it. So there are ways to subtract business expenses from business income. The first way is called a deduction. That's when you subtract it in the year that's purchased. Okay, so now what do I mean? You purchase something, let's say you run a business and let's just assume you're running your own personal business. It's just you, just for simplistic discussion. And we'll keep using that throughout this discussion except when I say otherwise. So assume you're running your own business and you buy some paper, okay, you know, to use in your printer. Well, you subtract that. So you might have made $1,000 in income during the year, and you paid $100 in buying boxes of paper. So you get to subtract that out. So your $1,000 income minus $100 leaves you with how much income?
900.
That's right. That $900,000 minus $100 of income. Excuse me, $100 of paper purchases. Well, that's a deduction, and you can only use a deduction for property that lasts less than 1 year. 1 year or less, I should say. 1 year or less is the key. If it's a year or less, you can actually deduct it if it's a deductible expense that's permitted. Or you can depreciate. Depreciation is the same thing. It's a subtraction, but it's over the life of the property. It's for big ticket items for property that lasts more than 1 year. Okay? So how do you deduct business expenses? You have two ways to do it. You deduct in the year that you buy it, or you deduct it over, and that's for property that lasts 1 year or less. Or you depreciate it, and you depreciate it over the life of that property. In other words, how long do you expect that property to last? Okay? Deduction or depreciation. Okay? And I keep hitting that because really, when it comes down to a business, that's the only two ways you deduct things. It's deduction. Excuse me, that's the only way you expense things is through a deduction for property that lasts 1 year or less, or you depreciate it over a certain number of years for property that will last more than 1 year. And you can depreciate your, what can you depreciate is the question here. Well, you get to depreciate your cost basis in the property. Well, now we're starting to find out how we use that cost basis that we spent so much time on. You buy a computer, going back to cost basis, you buy a computer for $1,000 and you pay $100 shipping and handling. What is your cost basis in that computer?
1,100.
1,100.
1,100, 1,100. Exactly right, guys. So 1,100. Assuming you use it completely for business, how much can you depreciate?
1,100.
That's right. That's exactly right. You depreciate the cost basis of your property. Because it's a computer, does it last longer than a year or a year or less?
Longer than a year.
Longer than a year. So you're going to have to depreciate the property and you cannot deduct it in the year that it was purchased. Okay? So that's basically how depreciation works. Also, this is out of order, so let's take this one next. Use only the business use percentage of the cost basis. So what that means is it's not real common in big companies, but in small companies, like like I said, let's pretend you're self-employed here. You're self-employed, you bought a computer that's worth, the cost basis is $1,100. In fact, let's just change that example to 1,000 for easy math. Let's say your cost basis in your computer is $1,000, and you estimate, but you use it partly for your personal use. I mean, it's at home in your home office, but you do use it a little bit for personal use. Let's assume that you use it 90% for business, and that's what you've estimated. 90% business use, 10% personal use. So what your business use percentage is how much in that example?
900.
What is the business use percentage, first of all?
90%.
90%. So if it's worth $1,000, what is the cost basis for depreciation?
900.
900. What you do is you take your actual cost basis in the property and you multiply it by the amount you use it for business. $1,000 times 90% is 900. That's the amount that you use for depreciation. Okay? Because that's all you can depreciate is the business part. Why is that? Why can you only depreciate 90% of your whole value, of your whole cost basis of that computer?
The rest was used for personal.
That's right. And the flip side of that same coin is you can only depreciate business property or investment property. And you're right, Amanda. Amanda says that's only the part for doing business. That's exactly right. And remember, we've touched on this a couple of times, and somebody pointed this out earlier. Do not depreciate land. So if you've got business property that happens to be real estate, why when we're figuring cost basis for real estate do we subtract the land out? We do it because we cannot depreciate land. Land always exists. Now, a not so funny story. I was almost going to say funny story, but not really so funny. When I was younger, we had a friend who owned real estate on a cliff above the Oregon coast. I forget where it was. It was beautiful. It was about 50 feet above the waves, and you could see the waves come crashing in. But every year they were losing about 6 inches to a foot of their property. And I'm sure by now that has gone crashing into the sea. So in a sense, you think they should have been able to depreciate that land because it was literally disappearing. But, you know, in theory, in tax theory, land always exists, and so it's always valuable, so you don't depreciate that. So that's important to remember that.
Would that be a capital loss if it fell into the ocean?
That's how I would take it. Well, I wouldn't necessarily take it as a capital loss. You could. We haven't gotten into that, but I'll just answer your question directly. I would consider it as a casualty loss is how I would.
Right.
That's how I would handle that. It's a natural catastrophe beyond your control.
Yeah.
So, but I don't want to trip people up or confuse them that don't really understand what we're talking about. Okay. All right. So depreciation, that's kind of a quick introduction to depreciation. So when does it start? It starts when you place property into service. That's not the same thing as saying when you purchase the property. So let me give a couple of examples. Let's say you run a business where you have 10 employees and you make shoes, let's say. You just bought this machine, $100,000 machines to help you put the soles together, okay? But you just purchased it, but it's not ready for service yet because you need to, first of all, get the old machine out and you need to train your employees on the new machine. Well, it's not in service yet. It's not in service until it's ready to be used, even if you don't quite use it yet, okay? So that's important just to know. There's a distinction between when you buy something and when you place it in service. Now, if you buy a computer, even if you put it on in your office and you have it available for use, but you don't use your brand new computer yet right away, you have actually placed it in service already because it's available for use. You just happen to have not used it yet. But if you buy that new computer and you say, I'm going to wait till this weekend to actually put it up, well, it's not in service until you put it up. Okay. So that's kind of the distinction. Another example might be if you own a rental. You buy a rental, but you need to do some quick fix up on it. And you know that's going to take about a month to fix up what you need to. Well, until you get it fixed up and you start advertising it for rent, it's not in service until you're starting to advertise or actually move someone in. So just an important distinction, but nothing to get too hung up on. Just keep that in mind. It's depreciation starts when you place the property in service. Depreciation ends when it has either been fully depreciated or it's no longer used for business. So what do you depreciate of an item? You depreciate what value of an item?
Cost basis.
The cost basis. That's exactly right. So if you've been depreciating long enough that you've gotten the entire cost basis used up, you're done with depreciation because you can't depreciate more than the cost basis. Or when you stop using it for business, even if you have not used up all your cost basis. Okay, so that's when depreciation ends. It starts when you place property in service. It ends when it's completely depreciated or you're no longer using it for business. Now, this is where we start getting into a few details. Now, each depreciable item fits into a property class. A property class just is, it's not a real thing. It's a concept created by tax law to help you to determine what types of items go into which class. And that's important because that will tell you how many years that you get to depreciate this over. So a property class life is what we're talking about. How long will the property be considered useful? Some property by the law is considered useful for 3 years. So you depreciate it, as it says there, that determines how long to depreciate the item. They depreciate that item for 3 years. Some property is considered 5-year property, and you depreciate that over 5 years. 7-year property is depreciated over 7 years. I think you see the pattern, okay? So there's a property class handout that I want to push out to you guys. I'd like you to, I don't think I've sent it out yet, or did I? I might have. I think I did at the very beginning.
You did.
Okay, perfect.
Yeah,
If
the
you
makers.
can, right, and then the makers depreciation tables. If you can, have you guys, those of you that can, print that puppy out because it'll be nice for you to refer to, okay? Those of you that can't print it out right now, do it later, but you could still click back and forth. You could bring it up on your screen and click between the presentation and that handout. Okay, so I'll come back to this property class handout when we talk about it in a minute, okay? I might even bring my copy up on the screen so we can look at it together. So let's talk about depreciation methods. There's two kinds of depreciation methods. There's a straight line method and then something called makers. So the straight line method just means you're taking an equal amount of depreciation each year during the asset's useful life. So let's say you have 5-year property, okay? And that means you're going to take an equal amount each year so that at the end of 5 years, you've used up all 100% of the value of that asset. So what would that mean? If I have 5-year property and I'm using straight line method, what percentage am I taking each year? Okay. I'm giving you guys a chance because I feel like you're still working on maybe printing stuff out. Garrett, I saw your answer. I'm just giving other people a chance to respond too. So the question is, if you're using a straight line method and it's going to take you 5 years to depreciate the property, what percentage are you depreciating each year?
20%.
20%. That's right. And I see everyone that wrote it in had that answer. That's exactly right. So if my cost basis in the property I'm depreciating is $1,000 and I'm taking 20% each year, how much am I deducting each year?
200.
$200 each year. Now that's straight line method. There's a thing that's called a declining balance method. It's part of makers. Actually, both of these are, but don't worry about that. I'll come back to that. Declining balance method means that you're going to get a cost recovery rate that is accelerated, or in other words, at 200% or 150% of the straight line method amount. In other words, what they do is they give you more deduction in the early years than they do in the later years. So why do you think the IRS would allow something like that, or Congress allowed something like that? Why do you think they allow a greater amount of deduction if you use the declining balance method early on? I mean, just sometimes it helps to understand the reasoning to remember why, to figure out why they're doing something and understanding it. So why do you think they might do that? Just go ahead and speak up. I'd rather, this is not something to write. Wait.
They're not given an incentive to invest in your business?
Yeah, and that's something similar to that Amanda wrote. Yes, I would agree with that, but how does that help? How does that help you invest in your business?
You to deduct a larger percentage of what you've input faster in the life cycle. So
Yeah, no, that's right, Garrett. When a person invests $1,000, especially if they're self-employed, say, and that's a, you know, and so they're self-employed, they've invested, say, $1,000 in, and they know they can deduct in the first year $200 rather than say $100. That actually helps them make ends meet. which means they're more likely to be successful with the business, which means they're going to be able to hire more people, do more work. You know, they're going to have more money to work with, which is going to help the economy. So that's the idea, is to help stimulate business growth. Now, what does this really mean? Accelerated method means you're going to get 200% of the straight line method. So like in the first year, rather than 10%, you might get 20%. Or you might, if you're using the 150% method, you're going to get, you know, $150 rather than just $100 off, perhaps, something like that. Okay. So now the modified accelerated cost recovery system, MACRS, is the most commonly used depreciation system, and it can use either straight line method or the declining balance method. So really both of these are available under MACRS. There was an old version that I don't really need you to know anything about other than it used to exist. It was called ACRS. Do not worry about it. It's so many years removed now that you're not going to see it much. We're like 25, 30 years removed from it now, something like that. MACRS is what we use. It is an accelerated cost recovery system that allows for a declining balance method, but in some cases it's straight line method. Okay, so 2 depreciation methods. And by the way, I'm going to introduce a term to you because you're going to see it on that that MACRS depreciation tables. You're going to see the GDS, as in general depreciation system. Just think of MACRS as a general depreciation system, okay? I know that's kind of confusing, but you don't need to know all the little details right now to make this work for you. Just know MACRS is a general depreciation system, and we're going to be talking almost exclusively about MACRS, either straight line or declining balance method. Okay. So, depreciation is a tax concept that determines, wait a minute, something's missing here. Give me just a second here, guys. My apology. I got to fix something here. I'm just going to throw these all up at once. It's in the wrong order. That's what happened. So convention now. Convention is a word. Now we're having to get into some terminology, and then I'll show you how it all goes together. So bear with me. There's a lot of terminology coming at you over the next 5 to 10 minutes, but just try to get the gist of it, and then we'll actually work with it a little bit, okay? So convention, that's just a tax concept that determines the number of months you can claim depreciation during the year. So when you buy something during the year, the question always comes, hey, if I buy something in August, do I get to claim it for the whole year or only part of the year? Some people would say, oh, you get to claim it for the month. Some people would say, no, you got to claim it by the number of days. So the IRS settled this by saying, okay, we're going to have something called convention, and there are rules that get to determine how much you get to claim depreciation during the year that you either first place the property into service or the year that you dispose of the property. That's the key. So this only applies to the first year and the last year that you have that property, that you're using that property for business. So for the year you place it in service, the first year, or the year you dispose of the property, last year. That's what this concept does, is tells you how many months during that year do you actually get a claim depreciation on it. So that's all convention does. Okay, so there are 3 kinds of conventions. Let's talk about them. There's the half-year convention. We're going to talk about each one individually. There's the mid-quarter convention, and there's the mid-month convention. Okay, half-year convention, mid-quarter convention, and mid-month convention. Again, what does convention mean? Somebody just tell me in your own words what convention means.
How to determine depreciation for the part of the year that it was placed into service or disposed of.
Okay, that's right. It's in other words, how many months during the year, or what part, how many months during the year do you actually get a claim depreciation for this? Okay, so let's talk about this. There are 3 conventions. Like I said, the first one we're going to talk about is half-year convention. First of all, here's the rule. In the year the property is placed in service or the property, you dispose of the property, treat it as if it was placed in service in the midpoint of the year. Okay? So, if I buy a computer for my business on January 1st, when will I pretend I first placed it into service? For which I'm going to use half-year convention. So
June
what's
1st.
the July 1st would actually be the
July
midpoint.
1st.
Yeah, because June is considered the 6th, so it'd be July, right? So it's the end of the 6 months, so it'd be July 1st. So that would be the midpoint of the year. So if I buy, let's say, a desk for my business, and I buy it on March 15th, when will I consider that to be placed in service, and when can I start depreciating that?
July 1st?
That's right. If I buy it on September 15th, when do I start depreciating it?
July 1st?
That's right. It doesn't matter when in the year you buy it, you pretend it starts at the midpoint of the year. That's exactly right. So that's the rule. Now, what's the result of the rule? The result is you get to only take half of the depreciation for that year. It doesn't matter. Even if you bought it on January 1, you're still only going to get to take half the depreciation for the year. If you buy it and if you happen to buy it on, even December 1st, you still only get to take, you still get to take half the depreciation for that year, even though you haven't owned it for half the year. All right. So that's the result of that. Now, if you do the math on that, what would happen when you got done with all your depreciation in the last year? You'd still have a half a year's worth of depreciation. Well, remember, a convention applies to the year you put it in service or the year you get rid of the property. So on that last year, you get to take the other half that you missed. Okay. All right. Now, most property will use this convention. Most of the time, you're going to be using half-year convention. So most of the time, you're going to start depreciating property on business property on which date?
July 1st.
July 1st. That's right. So that's half-year convention. Let's talk about mid-quarter convention. First of all, here's the rule. In the quarter, now we got to define what a quarter is. What does the word itself, quarter, mean?
1/4.
1/4, 25%. So if I take 12 months of the year and I divide them into quarters, what months are included in my first quarter?
January, February,
March.
That's right. April, May, and June is second quarter. July, August, and September is third quarter. Fourth quarter are which months?
October, November, December.
October, November, December. That's exactly right. So in the quarter or the 3-month period that the property is placed in service or disposed of, treat it as if it was done at the midpoint of that quarter. So if we have a 3-month period, let's say the 3-month period is January, February, and March. So the first quarter of the year. What's the midpoint of the first quarter?
February.
February 15th.
That's right, February 15th. Don't worry about the fact that February is usually a short month. It's still February 15th. What's the mid-month of the second quarter?
May 15th?
That's right, because the quarter is May, June, and July. The middle month, the middle day of the middle month. Okay?
May, June, and July? Wait.
No,
Oh.
April, May, June is your
okay.
second quarter. So I'm just saying the middle month, middle day of the middle month, which is May in that case. What months are included in the third quarter?
July, August, September.
Right. So what's the mid-quarter month there?
August 15.
That's right. And then the mid-month of the last quarter, midpoint of the last quarter.
November 15.
November 15th. Okay, so all this rule is saying is in the quarter that the property is placed in service or disposed of, treat it as if it was placed at the midpoint of the quarter. Okay? So what's the result? Well, you only get to take 1.5 months of depreciation for that particular quarter. But you still get to take the full depreciation for the remaining quarters of the year. So if you're using mid-quarter convention and you place some property in service in the first quarter, you start using for that property, you start using which date for depreciation?
February 15th.
February 15th, that's right. So from February 15th through the end of the first quarter, you only get to take half the depreciation. But guess what? For quarters 2, 3, and 4, for the rest of the year, you get to take the full depreciation for each of those quarters. Okay? Now, why would you do this? Because it's required in this situation. If the basis or cost basis of your items placed in service in the last quarter of the year is more than 40% of all the basis placed in service during the year, you must use it. Boy, that's a lot of words. So what we're saying is, take a look. What you want to do is you want to go through the whole year and add together the cost basis of all the items that you first placed into service. Okay? So you take all of the items that you put in service during the year and you figure out what the cost basis is for all those items together. Now, then what you do is you go and look at just the last quarter of the year. The last quarter of the year are which months?
October, November, December.
That's right, October, November, December. You take a look at what items you placed in service in just the last quarter of the year. And figure out what the basis is for just those items. Then you compare the cost basis for all items you put in service during the year and compare it to the items you put in service, the value of the item, the basis of the items you put in service during just the last 3 months of the year. If the last 3 months, the basis for the last 3 months of the year is more than 40% of your entire basis for the whole year, then you have to use this convention. I'm letting that one sink in. That's kind of a little weird. That's just a little bit strange.
You have to use this convention for every type of property you bought, for the previous part of the year. Or
No, that's a great question, Linda. Let me make sure I think I get your question. Let me rephrase it. You're asking, hey, let's say I did buy some items in the last 3 months of the year, and it is more than 40%. Do I use mid-quarter convention for everything I bought during the year or just for that in the last quarter? That's your question, correct?
Yeah.
Okay, the answer is yes, you do. That's why you go on each quarter. Then you have to figure out when something was purchased and you go to the mid-quarter, the midpoint of that quarter, and you start with a midpoint of that quarter plus all the other quarters for every item you bought. And you have to do it individually. So some things might start, if you bought some stuff in the first quarter and some stuff in the last quarter, the stuff you bought in the first quarter, you would start depreciating on what date?
February 15th.
That's right, February 15th. That's exactly right. And then for the first quarter items, it'd be February 15th through the end of the first quarter, plus all of the rest of the quarters for those items. So you get to take the full amount of depreciation for quarters 2, 3, and 4 for those items. And then for the items you placed in service only in the fourth quarter, you start on November 15th to the end of the year.
Can I ask a question?
Absolutely.
So if it doesn't equal more than 40% of all your other basis for the year, then you use half year?
That's right. Yeah, that's exactly right. Yeah. So you just use mid-quarter only if it meets this one specific requirement. If not, it defaults back to half year. Now, why do they do this? Let me tell you why. It's the IRS trying to not give you too much. It's the IRS trying to basically say, okay, if you've placed more than 40% of all your new assets into service right near the end of the year, we're not going to give you as big a deduction in the first year as we otherwise would. That's all it is. That's all it is.
Okay, so say you start a new business in the beginning of the year, you bought like the office furniture and stuff like that.
Okay.
And then you're going through and sorry, my dog.
It's okay. It's all right.
I gotta write it. Hold.
No, go ahead, Lisa. Go ahead and talk it through. It's okay.
Okay, and so then on like October, you bought a whole bunch of machinery for like $10,000. You would then do the mid-quarter thing.
Yeah, and you'd use mid-quarter for everything you bought all year long. You see what I mean?
Okay, I get it.
Yeah, that's the thing. If you're kicked into mid-quarter, you use mid-quarter for everything. Okay? All right. Any more questions or comments about mid-quarter? By the way, mid-quarter is the trickiest one to get your head around, but once you figure this one out and know when to apply it, it's pretty simple, because if this doesn't apply, then you just default back to half year. Okay. Do we feel confident moving in? And Amanda, I'm sorry, I just now saw your question. I'm not sure when you asked that. Is that because some people try to hide profits that way? I wouldn't say necessarily because of hiding profits, but it's sort of what I said. It's just a way to account for, so somebody is not getting to decrease their profits too much. I wouldn't say hide. That implies, somebody trying to unfairly avoid taxes, but some people might structure their purchases in a way that they hardly pay anything during the year, but they're getting all the tax benefits. So it's just forcing them to spread this out a little bit more. Does that help answer your question, Amanda? Okay, cool. Thanks.
Is it more advantageous to use mid-quarter?
It can be, actually, in some cases, it can be. I mean,
Okay.
I can see it being a disadvantage if you put a bunch of stuff in service late in the year, because you put out all this money, but you're not getting to take as much depreciation. But it certainly could be for the other items you bought earlier. So
Because our computer is default in half year.
yeah, it will default if it doesn't meet mid-quarter convention. Yep.
Okay.
Okay. So are we good on mid-quarter convention? Think so? Okay.
Yes.
All right. So let's talk about the next one, mid-month convention. Well, this says that in the month that the property is placed in service or disposed of, treat it as if it's done at the midpoint of the month. So if you purchase property and this rule applies, if you purchase property in January, you start depreciating on January 15th. If you buy it in February, February 15th, March 15th. So guys, here's a tricky question. If you buy it in June, when do you start depreciating it?
June 15th.
There you go. That's it. That's exactly right. I was reading something that Garrett wrote here. Purchase the bulk of machinery in October. Yeah. Yes, Garrett. If I understand that right, yes. So the rule for mid-month convention. In the month the property is placed in service or disposed of, treat it as if it was done at the midpoint of the month. Okay, now that's kind of saying the same thing, but what we're saying is that's when you start the depreciation. Okay. So what's the result? You get to take only half of the depreciation for that first month plus full depreciation for the remaining months of the year. Okay. So half the depreciation for that month plus full depreciation for the remaining months of the year. Now, here's the thing. This is required for residential rental property and non-residential real estate. Okay, I want to just repeat that. For residential rental property and non-residential real estate. This convention is required for real estate. That's what I want you to know. This is required for real estate. So if it's real estate, are you ever going to use half-year convention?
No.
No, you're not. If it's real estate, are you ever going to use mid-quarter convention?
No.
No.
Now, is that true even if you bought the real estate in December?
Yes.
Yes, it is true. That, in other words, just to clarify, even if you bought it in the middle of December, you're still not going to use mid-quarter convention because you always use mid-month convention when it's real estate. That's what I need you to remember right there. Okay. Now, depreciation is calculated using a table. Okay. So these tables provide depreciation percentages. In other words, you'll go down and you'll look at a column that applies and it'll tell you what percentage you're going to use. And which table you use depends on your recovery period. In other words, 3-year, 5-year, 7-year, and so on. What convention you're using. What are our 3 conventions that are possible? What's the first one?
Half year.
Half year is the first one. The second one is?
Mid-quarter.
Mid-quarter.
Mid-quarter. And the third one is?
Mid-month.
Mid-month. That's right. And it's also looking at depreciation method. And what do we mean by that? Well, are you using straight line or are you using 150% declining balance method or 200% declining balance method? Now, to calculate that depreciation, you apply the appropriate percentage from the relevant table to the property's basis. So what you do is you go to that table, you look at the percentage you need, and then you go to the cost basis of that property and you multiply it by that percentage. That's how you determine it. Now, here's the good news. In real life, the computer program is going to look that up for you, but you still have to make sure to enter the right property class and the right cost basis for the asset. So, when calculating a taxpayer's depreciation deduction, here's the steps. First of all, make sure the asset is eligible for it to be depreciated. What types of assets are eligible for depreciation? We started out our entire discussion with this. What assets are eligible to be depreciated?
For business use.
Okay, business use is one of them. What else?
Investment.
Okay, an investment property, like personal investments, like your coin collection or something like that. So you can depreciate investment property, your personal investment property that's not business, and you can depreciate business property. Now, let's say you live in and own your own personal home, but you're living in that home. Can you depreciate that?
No.
No, you can't. Why?
Because it's not a business use.
That's
It's not
right.
a rental property.
That's right, and it's not. That's right, and it's not a depreciation, and it's not an investment property, unless you have a rental. Okay, that's exactly right. So the first thing is you want to make sure the asset is eligible to be depreciated. Second of all, you want to identify the date the asset was placed in service. Why is this so important to make sure know when you first started using the asset for your business or investment? Why is that important?
To determine what method of depreciation to use.
That's exactly right. We don't know what method to use, and we need to know the method to use and that date to know how much depreciation we take for that year. That's exactly right. Third, determine the basis of the depreciable asset. Well, that's what we spent the first entire segment of this discussing. How to figure cost basis. So we've already gone through that. So you want to determine the basis. So again, just backing up, we're not done with the steps yet, but just backing up, you want to first, you don't want to waste your time. Make sure the asset qualifies for depreciation. If it doesn't, then don't waste your time with anything else. If it does, find out the date that the asset was purchased and determine what the cost basis of that asset is. Okay. Once you do that, reduce that basis by applying the business use percentage. Well, you remember that. you got your basis in the property, but now if it's not 100% used for business, you need to decrease it to just the business use percentage. Then this is where you've got to identify which depreciation system are you using. Are you using straight line? Are you using 200% declining balance or 150% declining balance? Which system are you using? Which convention are you using? Are you required to use the mid-month convention? Or, well, let me use it in the order I taught it to you. Are you going to use the half-year convention, or are you required to use either mid-month convention or mid-quarter convention or mid-month convention? And then the method, and then the recovery period. How many years are we doing this over? You need all that information so you can get to the correct table. That's why we got to pull all that info together. And then you actually go to the correct table to calculate the depreciation amount. You pull that percentage off the table and you apply it to the basis. So how do you do that? You find the maker's percentage from the table, and we're going to look at the table in a minute. But we're going to apply the maker's percentage using the info that you got from step 5. And that's that maker's chart that I sent to you. And what it does is the chart kind of summarizes all the many different tables, and it tells you which table to go to. And then you take the percentage off of that and multiply it by the business use basis that you calculated in step 4. Okay? So we're going to do an example here in a minute, but I think what we need to do is I need to get out of this and I need to pull up our 2 handouts that I gave to you guys. I think we need to take a look at those handouts first. So those of you that have been lucky enough to be able to print out the property class handout, let's take a look at that first, okay? I'm pulling it up on the screen though, so we can all look at it together. Okay, so this is the property class handout. Let's look at the different columns that are here. You have a property class, the name given to the class, and you have the recovery period. Then you have the allowable conventions, and then the types of property that can fit within that. Okay, so let's kind of go through it. First of all, look at the property class name. 3-year property is a recovery of 3 years. 5-year property is a recovery of 5 years. Now, that's pretty easy to remember. They weren't real creative with the names. 3-year property recovered for 3 years, 5-year for 5 years, and so on. 15 for 15. The only place it gets different is residential rental property is the period of time you recover it over is 27.5 years. Non-residential real property is 39 years. I do want you to memorize those 2 amounts because you might run into those in questions. If you own a rental house, how many years can you depreciate that rental house over?
27.5.
That's right. What if you own, let's say you purchase a business building that has like office space in it, and you rent those offices out to various professionals. That's called non-residential real property. How long do you depreciate that over?
39 years.
Exactly right. Okay. So let's come back up here and take a look. The next column is what conventions can you use on that? Well, 3-year property can use half year or mid-quarter. Well, that makes sense. You use half year if you can. You use mid-quarter if you're required to. Somebody remind me when you're required to use mid-quarter, and just explain it the best you can.
When all your assets, assets that you bought through the year total, all your assets for the last quarter total 40% of all your assets for the whole year.
Yeah, just to be a little more accurate, it's more than 40%. If it
More
was
than
just 40%, you wouldn't have to. But if it's more than 40%, then you have to use mid-quarter. Otherwise, you're using half year. Well, guess what? 5-year property are the same. 7-year property is the same. 15-year property is the same. Residential rental property. Remember the rule? What convention do we have to use for any real estate?
Mid-month.
Mid-month, that's right. So residential rental property, that's why it shows mid-month. Non-residential real property is also mid-month. Okay? So coming back to the fourth column. The fourth column gives you some examples of what could be in there. This is by no means a complete, a holistic list, but this gives you some ideas. 3-year properties, and I'm going to try to hit the really big ones, but it's a good idea to know some others. Tractor units for over-the-road use. These are not tractors on a farm. We're talking about those big trucks that have, those units on them when they're, the big haul units over the road. Racehorses that are over 2 years old, that are when they were placed in service. Any horse that's 12 years old. Are you really going to run into these two very often? No.
No.
But don't be surprised if you get a question like about a racehorse. I've seen racehorse questions on there. Racehorse that's 2 years old when they're placed in service. Remember, you might own a racehorse as a colt or purchase one as a colt, but you can't start racing them usually for a couple of years. So it's when they first are put in service. How old were they? Or other horses if they're 12 years old, so 2 or 12. Qualified rent-to-own property, don't worry about that at all. 5-year property. This includes automobiles, computers and such, office machinery and such, research equipment. I'm not sure if you'd get this. You might get a question about breeding cattle and dairy cattle. You might. But breeding cattle, and I want to stress breeding, not regular cattle. Breeding cattle, because you're holding that for specific use to breed. And dairy cattle, again, you're holding that for specific use to breed. Now, when you're learning rules, try to look for patterns. How do these two type of cattle differ from all other cattle?
It's
Because
breeding.
you're making money off of them. Breeding cattle because you're selling the offspringing dairy cattle because you're selling the milk.
Yeah, that's exactly right. They're holding, they fit into a different category because they're being used different than your standard cattle that you're just raising, like for beef, for example. That's exactly right. Also, 5-year property are items used in a residential real estate. So if you go buy an appliance, or you put in a carpet, or you buy furniture for it, all residential real estate activities fall into the 5-year property. Okay. Now I'm talking about the stuff inside the house, not the house itself. What might be included in 7-year property? Office furniture, agricultural machinery, and this is the catch-all category. If it doesn't fit in any of the other classes, use 7-year. So for purposes of learning, really focus what's 3-year, 5-year, and 7-year. That's really where you go. 15-year, be familiar with this. Improvements to land might be 15 years. Like you add a fence, that might be 15-year and so on. But residential rental property and real rental property, we already know. Residential rental property includes building of structures for a rental home. Non-residential real property is residential real property that's used in renting, but not for homes. They're professional. Okay, so you do need to know this because that's one piece of the information that you need to be able to calculate depreciation. You need to know, and there's 2 pieces of information you need to know on here. You need to know what is the class life, or the number of years you can depreciate it, and what convention are you using. Okay, so I'm going to close this. And then we're going to take a look at that depreciation table that I sent out to you. We're going to show you how to use it. Okay. So this is a maker's depreciation table guide. And notice it says general depreciation system and alternative depreciation system. That's because this is all, I don't want to say they're the same thing, but just know for our purposes, I don't want to get into all of the details of this because you don't need it for our purposes. The details, some of these details are more than you need to pass the test, even though at some point it would be good to learn it better. But you want to start with chart 1. But how do you know if you use chart 1 or chart 2? Well, you use chart 1 for any property other than residential rental and non-residential real property. In other words, you use chart 1 for anything that's not real estate. That's the way to keep this straight. Chart 1 is for anything not real estate. So now, how do you know which one to use? Well, again, anytime you see GDS, know we're talking about the Makers system, okay? So if you're using GDS or Makers and you're using a 3-year, 5-year, 7-year, or 10-year period of time and not including farms, farms have a little bit different system that you look at. And you're using the 200% declining balance method. So you're using Maker's GDS system. So see what I mean? Maker's system, there's 2 kinds. We're not really specifying any more than Maker's GDS is what we're talking about. Non-farm 3, 5, 7, or 10 years. And you're using the 200% declining balance method. And we're using half-quarter convention. Okay? And notice the recovery period corresponds with the class life. I told you before, the name and the actual class amount, the class names and the recovery period correspond. So if you're on this line, you can use table A-1. In fact, not can, you need to use table A-1. Okay? What though if, let's say you have everything is the same. You're using the Maker's GDS system. You have 3, 5, 7, or 10 year, but you're being forced to use the mid-quarter convention because of that rule. Well, then you need to use, for first quarter, you need to use A-2, second quarter A-3, third quarter A-4, fourth quarter A-5. Okay? So that's how you're using this. And this is just to get you to the correct table. And then we're going to look at a table here in a minute. What if you're the same situation as above? Notice this line here is exactly the same as this line down, where am I? Here, except the only difference is you're using 150% declining balance rather than 200% declining balance. If you're going to use 150% declining balance, use table A-14. If you're using 150% declining balance and you have to do mid-quarter, you do one of these tables, and that's based purely on which quarter you're dealing with here, which quarter it's in. Yes?
Can I ask a question?
Yeah.
When do you use 200% and 150% declining balance?
That's your choice. Depends on how much of an look. When you're doing tax returns, imagine you're running your own business. Doing regular depreciation is really beneficial to you over the years because it gives you, as you start increasing, your income, you got this extra stuff to deduct or depreciate. Okay, but remember, the accelerated depreciation method of 200% gives you more now than later. This gives you a little less now than later than the 200% does. So it really depends on what's best for you as the let's say self-employed person. You want to know. I mean, maybe you need some extra depreciation now, but you would like to leave a little bit more of it for later. For later years, you can use this rather than this, and this will take more now and leave you less for later. This will take a little bit less now and leave you more for later. And if you chose to use straight line method, which is the one I'm highlighting there, that would just take it all equally each year. So what do you get? You get to choose which one you want to use. Now, as a practical method, we normally will use 200%. A lot of times, though, if we were trying to save a little bit for later years because we anticipate their business is going to grow, you might use 150%. Make them not give them as quite as good a value now, but give them a little bit extra later to depreciate. Did that answer your question?
Yes.
Amanda, can you, I just now saw something you typed in there, and I'm sorry, you're keeping them long enough to have an offspring? Can you help me out? I'm not sure what you were responding to when you wrote that.
The cattle.
Cattle.
Oh, the cattle. I was like, I could not figure that one out. Okay. All right. So that's how you do it. So let's say we're in this very first line and it tells us to go to table A-1. Well, go down to table A-1. There it is. And then we have, look at this, we have year 1, 2, 3, 4, 5, and all the way through year 21. Well, keep in mind, this table is for 3-year, 5-year, 7-year, 10-year, 15-year, or 20-year property. That's why it goes through 21, because remember, you only get part of it in the first year and part of it in the last year. That's why it's always going to go 1 year longer than the actual depreciation. Okay, so you look at the year on the left, which year of depreciation am I in, and then you look at the rate of recovery. Is it 3-year property, 5-year, 7-year? So let's say I have 3-year property and I'm in year 1. I take 33.3%. What if it's 7-year property and I'm in year 1? 14.29%. What if I'm in 15-year property in year 1? What is the percentage? Just go ahead and speak it out.
20.
No, 15-year property.
15.5.
Yeah, and I'm not sure if I may have said that wrong. That's why I needed to correct myself. So 15-year property would be 5% in the first year. So let's say we have 7-year property, and this is the 3rd year that we're depreciating this property. What percentage do we use?
17.49.
That's right. What if I have 5-year property and I'm in the 5th year?
11.52.
0.52.
11.52. That's exactly right. Yeah, that's correct. And when you guys see me look off the side, because I have a second computer up to help me with the chat, and Amanda just was writing the same answer. Okay. So that's how you use it. So now let's say we're in 3-year property and we're in the 2nd year. What percentage do we have?
44.45.
That's right, 44.45. Now we take that percentage and what do we multiply it against? In other words, what are we multiplying by that percentage?
Basis.
The basis.
Yeah.
And to be specific, it's the business use basis, not the total basis, but the business use portion basis. Okay? Now, I want to go back up just to point out that we skipped over chart 2. Chart 1 was for non-real estate. What about real estate? We'll use this chart to correct percentage table for residential rental and non-residential real property. Well, in this case, we're using GDS system. And realize I did not put GDS on there. It's basically the standard makers that we mostly use. We're using straight line method. Why is that? Because you'll notice you have no other option. When you're dealing with real estate, it's always straight line. Okay? You're using for rental real estate, residential real estate. How many years do we recover that over?
39.
0.5.
Wait a minute, I heard some different answers. Residential rental property is how many years?
27.5.
27.5. Non-residential real property is either going to be 31.5 or 39. In most cases, 39, just to let you know. There are circumstances where 31.5 can apply. That's why it's there. But assume 39 for purposes of testing. Okay, so let's say you have a rental home. Which line are we going to use, 1 or 2?
1.
1. It's this one right here. What is the depreciation method we're going to use?
Straight line.
Straight line. What convention are we going to use?
Mid-month.
Mid-month. You'll notice straight line and mid-month, those are required by law. You don't even have a choice on that one. Like you up above, you had a choice. You don't on this one. Okay. What table are we going to use?
A6.
A-6. So let's go down there and look at it. Oops. And oh yeah, I did put it in here. So residential rental property, we have to use mid-month convention. We have to use the straight line. Oops, sorry, straight line for 27.5 years. I'm trying to get just that part highlighted, and I'm getting everything. Now, it works the same way. In the first year, let's say I buy a rental real estate property and I place it in service in June. In my first year, what percentage do I take? So I rental real estate, I purchase it in June, and this is the first year. What percentage do I use?
1.97.
That's right, and that's what, yeah, 1.97, that's, Amanda wrote that in there too. That's right, 1.97%. So please tell me, how much do I get to deduct in the first year in that example if my cost basis in my house, not including the land, is $100,000? How much am I going to deduct?
$1970.
Yes.
That's right, 1970, $1,970. That's exactly right. Okay. Okay. So that's how that works. In the second year, what percentage do I get to deduct?
3.636.
That's right. You notice you stay in the same column for the whole time, 3.636. Okay, and that's how it works. That's how this works. So now I'm going to close. Now I do want you to know the copy I sent out, I did not include all of the tables. Okay, so there's some tables missing that you would actually have to get into if you really wanted the full thing, but you can find that online, or you can get into the IRS book, the Pub 17, and get it too. Okay, so let me go back to the PowerPoint presentation, bring this back up.
Question?
Yeah, go ahead.
In what case would you depreciate residential property?
I'm not sure I understand the question.
Okay, when you're selling residential property,
When you're selling it?
yeah, would you use a depreciation on it? I mean, I don't depreciate the house I'm sitting in.
No, but you do depreciate your residential rental property because it's in the form of a business.
But it's talking about residential and non-residential.
Right.
I don't understand why they differentiate.
Non-residential is like a office building.
Oh, okay.
Yeah, exactly. Let's say residential rental is like you buy a single family home or a duplex and you rent it out to someone.
Got it. Okay.
Yeah. But let's say you decide,
As opposed
hey,
to an
I
office
want to,
building.
right. Let's say you just go buy an office building and you're starting to rent out office space. Now
Got it.
you're in a different category. So
Okay.
these steps here that are here, these are the steps to actually do it. And what we just spent all of our time on just now was how to use that maker's percentage from the chart and then actually how to calculate that. That's what we are dealing with. So let's go through an example together. So here's Willis. He placed a new computer, and realize we were talking about real estate just a second ago, but this applies to anything. Willis placed a new computer in service for his business on May 3rd. Okay. It was the only asset he placed in service during the year. He used the computer, 90% for business. He paid $1,222 for the computer. Now he is going to use the depreciation maker system, the general depreciation system, the GDS part of makers. He's going to use the half-year convention, and we choose to use the 200% declining balance method. His recovery period, remember looking on that chart, recovery period is going to be 5 years for computers and peripherals. Okay. Okay, so follow these steps to calculate that. So first of all, make sure the asset is eligible to be depreciated. Can he depreciate that computer?
Yes.
Yes, it is eligible. I'm kind of ahead of myself a little bit here, but what percentage of that is eligible?
90%.
90%, the business use percent. Then identify the asset, the date the asset was placed in service. What date was that asset placed in service?
May 3rd.
May 3rd. Then determine the basis of the depreciable asset. What's the basis?
Did he buy it for 1,220? I don't see if there was tax on there or not.
No. Just I would have said there. I would have given it to you. No, it's
$1,100 rounded up.
1,100.
That's right. That's right. Then you reduce that basis by applying the business use percentage. And then I think you guys already did that. You kind of jumped ahead on that, and that's fine.
Yeah,
That's okay. You did right. You did right. Then you identify the appropriate depreciation system, convention, method, and recovery period. So let's just quickly, what depreciation system are they using?
Mid-month.
That's well, that's the convention. What depreciation system are they using?
Oh,
Straight line.
Backers?
makers.
They're using makers, and he was choosing to use
5 years.
well, he didn't choose 5 years. That's the recovery period that's required
Yeah.
because it is a computer. That's okay.
200%.
Now, what method is he using though?
200%.
That's right, 200% declining balance, because that's what we chose,
Declining
method.
balance.
And the convention is what?
Half year.
Half year. So there's all the pieces. And then you calculate the depreciation amounts. So there's the steps. So here, you guys kind of went through this. I forgot how I set up this slide. So the date it was placed in service, May 3rd. Determine the basis of the depreciable asset, $1,222. That's the basis. Now the business use percentage you guys gave me was exactly right, $1,100. That's the $1,222 times the 90% business use. And then we determine what they're using, makers, half-year method, half-year convention, 200% declining balance method, 5-year recovery period. We have to know all that so we can calculate the depreciation amount, which we're going to do on this slide. Boy, my order is messed up, so sorry about that. So what's the first thing we do? We find the maker's percentage in the chart. So in the chart, what is the percentage for this individual? What percent should we be using in the first year?
20%.
That's right, 20%. Then we calculate the depreciation for the computer. So we take $1,100 times that 20% from the chart gives us $220. That's his depreciation amount. Oops, I went ahead of myself, sorry. So that's the amount he gets to depreciate for the first year. Does that flow make sense? Now, what I think you guys ought to do is when we get this posted on that website, you should go through this a little bit and just play with it so you can do it yourself. Just get familiar with it. Don't spend a ton of time on this because I do not think this is complicated. What gets confusing, though, is just to remember to get all the pieces and plug them in right. That's the only part that's hard about this.
Question.
Okay, go ahead.
During the exam,
Yes.
they will provide the table.
Yeah, if they look, if they ever ask for something, they're not expecting you to memorize the table.
Yeah.
They will give you a cutout, or they'll give you the various percentages that are available. They'll do something to, they're not going to expect you to memorize the tables, which is what I think you're asking. Okay?
Yes. I cannot memorize.
Be honest with you, a lot of these questions are probably going to be more generic questions.
Okay.
What I mean is you don't have a ton of time to calculate too much. So a lot of these questions are going to be more like, how do you do this? Not what is the answer from this calculation. So just understand the process and make sure you could do it so that if they ask you a question about the process, you'd say, oh yeah, I know how to do that. Okay?
Okay.
Okay, so talking about depreciation a little bit more, The depreciable amount for the asset is then reported on the appropriate form. So now we've calculated it. Now that we've gone through all of that, why did we do that? So we could figure out, so we could put it on the tax return and use it in some way. Now, we haven't talked about how we're using these things, but we're not going to get into a whole lot of it now, except to tell you the different ways and places it can be reported. Where it gets reported depends on what you're doing. If you're running a business, it gets reported one place. That's different than if you're running a farm, and that gets reported differently if it's just personal investments. Remember, personal investment assets are different than business assets, but they're still depreciable. So, such as, where would it get reported? Well, first of all, you always want to do a depreciation worksheet to calculate things and then keep a record. That's important because as you can see, every year there's a different depreciation amount if you're using accelerated system. Okay, and if you're using that accelerated system, let me back up what I was trying to say. If you're going to use an accelerated system, which most of the time you will, you need to keep track of where you're at in that accelerated system and how much you've actually taken. And there's reasons for that for later years depreciation and other reasons that I don't even want to get into right now. Okay. And just, I'm going to give a hint for those that are a little more advanced in this course. One of the reasons is you need to know it for recapture purposes in case you sell the item earlier than when you finish depreciating it. So don't worry about it if you don't understand that. So you want to do the depreciation worksheet. You want to do form 4562, and the name of that form is depreciation and amortization. So you want to do that. That's where you keep a formal record of what you're doing, and then it actually gets attached to your tax return. And then you want to report it either on Schedule C if you're doing a business, or Schedule E if you're doing investments. Like we said, you might have investment property. Schedule E, for example, can be used, among other things, for rental property. And there's another one that probably should be on here, Schedule F for farming. So, okay, so that's where you report it. Now, the good news is the program in real life, your computer program does this for you too. But you need to understand this because we got to have you pass an exam first. Okay?
Okay.
So let's do some practices. Which statement, and I want you to put your answers in the chat. Which statement does not apply to depreciable property?
It must be rented.
All right, put it in the chat if you can, okay?
Okay, sorry.
No, it's okay. The reason I want to do it is I want to get everybody a chance to answer without being too influenced by somebody else's answer. Normally, I like quick answers, but right now I'm wanting everybody a chance to interact with it. I think I have everyone's answer. Okay. The answer is A, just like you said, it must be rented. That's not a requirement for depreciable property. What is a requirement is it has to have determinable useful life. In other words, it has to have 3 years or 5 years or 7 years or so on. And it must be expected to last longer than 1 year. If you buy something that lasts less than a year, what do you do with it? Do you depreciate it, or do you
Expense.
You expense it? That's right. You deduct it. You expense it out. You actually get to claim it all in the first year because it's going to be gone by next year. And you must also, for depreciation, it must be used for business or to produce income. Okay. Good job. So here comes the next one, and give me just a second. I'm doing, oops, hold on a second, guys. I hit something wrong. Next. This is so I can keep your answers straight. Tom owns the building where his financial planning business is located. So before we go any further, what does he own? Somebody explain to me in layman's terms what he's owning here.
Commercial property.
Commercial real estate, exactly. And which asset is depreciable? Now think about what he owns. What's depreciable?
The building.
I'm just holding off for other people's answers too.
Oh.
That's okay. Okay, so I want you to think about the answer here. First of all, is there anything here? Well, actually, I'm just going to give you the answer and then we'll talk through. A. Now, why is office furniture depreciable? Well, first of all, is it used for a business?
Yes.
Everyone would agree it is. And what class life does it fall under? 3, 5, or 7 years?
7.
That's right, 7 years. Now, let's rule out why these others are not accurate. New outlet covers. Can someone tell me why those would not be depreciable?
Building maintenance.
It's maintenance. It's an expense, something that you just expense out. Why is the land not depreciable under the office building?
Land is not depreciable.
That's exactly right. Why is extra clothing kept in the office not depreciable? I'm chuckling because this is kind of a weird question.
Yeah.
Less than 1 year.
No, there's a real, we've talked about why. We just haven't related it to clothing. Why is clothing not depreciable?
In this case, it's not for business use.
That's right. It's not
Yeah.
a business item. It's not a business item. It's not for making money.
Unless
That's
it was
why.
a retail store that was selling clothing, and then it
Yeah.
would be.
Yeah, that's right. Exactly right. So, okay. So let's go on to another one. And this one I want, and by the way, Lisa, I saw you typed in the same answer. So this next one, I want everybody to type in their answer. When does depreciation for an asset begin?
Your slide is not yet turned. Okay.
Did it show up? Sorry about that. It's showing up now, doesn't it? Okay. So just read through those and give the answer. And it looks like I think all of you did. Yes, you guys are right. Do you know a lot of people get B and C confused? It's not when you first use it for a business. It might sit there for a month before you start actually using it, but as long as it's available for use in that business, then it's good. That was good. Good job. Okay, so we're going to go to the next one. Who wants to read this question for us?
I'll read it.
Okay, go ahead, Garrett.
Depreciation for an asset ends under all of the following circumstances, except.
Okay, and then type in your answer.
Why I cannot read? My slide is not yet there.
Okay, that's all right. Then let me know when it comes up. I'm guessing it's probably on your end. Can everybody else, well, obviously Garrett could see it. Can everyone else see it?
I can see it now.
Yes.
Okay, yeah, there's just some reason there's a bit of a delay for you. So, and keep us true to that. So in other words, let me know when you can't see it so I can slow down for you. Okay, so depreciation for an asset ends under all the following circumstances except, and you're correct, the answer is D, when the taxpayer no longer makes a profit from the business. In other words, all the others are reasons for it ending. When the asset's no longer used for business purpose. If you're not using it for business, you can't keep deducting it on your return as a depreciation. When the asset is sold, once you've gotten rid of the asset, you can only depreciate it up through the date of sale, and then you can't depreciate it any longer. When the asset's basis is fully recovered through depreciation. So those are all reasons that a depreciation would end. That's good, guys. Okay, so here comes another one. Please make sure that you let me know when you can see it. Okay, so here it is. Carmen bought a copier for $1,020 to use exclusively in her business. She paid $50 for shipping and $100 for setup. What is Carmen's basis in the copier? A, B, C, or D? There we go. I think I've got everyone's answer now. Okay, good. Good deal. Good deal. 1170. So, Amanda, could you jump in and tell us how you got to 1170? I know she's with us because she was typing. I added, okay, I'm going to read her answer. I added the initial cost and then the shipping and setup. That's exactly right. You just add it all because those are all things that go into into basis. Here's another one. Hope purchased a house to use as a single family rental. What recovery period will she use? Just go ahead and speak this one out to me, guys. Just
C.
The
27.5.
okay. Does anyone disagree with that? Is there somebody who thinks it's some other percentage, or excuse me, not percentage, some other answer? Okay, that is correct. It's 27.5 years. That's for a rental, a residential rental where people reside. Now, Greg purchased a computer to use it in his business. What recovery period is he going to use?
5.
5 years.
5.
That's exactly right. 5 years. Good job. And yes, I can see everyone that has typed in that answer got it too. Okay, so Greg also purchased a new desk for his office. What recovery period will he use? Go ahead and just shout it out, guys.
7.
7.
Anybody think it might be 5 years? No, you guys are right. I can't trick you. You're doing good. 7 years, that's exactly right. Which of the following is not a maker's convention? A, B, C, or D?
B.
Anybody else?
B.
Oh yeah, I see some people typing. You're exactly right. There's no such thing as full year convention. Okay. Margie placed a factory building in service on December 21st of the tax year. Her basis is $450,000. She does not have any other assets placed in service during the year. Which convention is used for the building?
Mid-month.
Mid-month.
That's exactly right. Why? And it's not mid-quarter, even though all of her basis is in the last quarter of the year. The reason is because mid-month trumps when you have real estate. That's exactly right. Darlene paid $700 for equipment that she uses 82% for business. What is her basis for the equipment? I want you to type in your answer.
Huh? I don't have the slide yet.
Okay, that's okay. No, I mean, I'm sorry about that. It's
Yeah,
on.
I'm sorry. Yeah.
No, it's okay. Just if I'm getting ahead so you can't do it, I want you to slow me down
It's
because I
okay.
just don't know. Do you have it now?
Okay, Darlene paid 700.
Noemi, when you get the answer, tell me what the answer you get. Okay?
Yeah, 574.
Good job.
Sorry.
574. That's exactly right. Okay. Woo. We got through it. Okay. So that's basis and depreciation. As you can see, that's really important information for you to know.
Yeah.
Okay. Okay. So where are we at with this? We've gone through basis and depreciation, and we have another class to get through 2 more items. It's called capital gains and losses and special considerations for depreciation. So remember when I said, when we were talking about basis, we were saying, why isn't basis important? Because we need to understand basis and how to calculate it so we can use it for depreciation. Well, now we've seen how we do depreciation, why it's important. But there's another situation we got to go into, and it has to do with capital gains and losses, and really sales is what we're talking about. When you sell an item, you first have to know not only how much you are selling it for, but you also have to know what is your basis in the property, because we got to figure out how much gain or loss you had in that. And we're going to talk about that in the next session. It's 2 o'clock now, and I think we're going to actually end on time today. But next session, we're going to be talking about capital gains and losses, and then we're going to go into a little bit more special details about depreciation. But I want you to know this is the stuff where there's a lot of meat I'm feeding you. I fed you a lot today, and there's going to be a lot I'm going to feed you on the next session. And once we get through that, then we're going to be able to get back into that concept of what is income or not that IRS will tax. And why do we have to go through all this now? Because these are things that you can take off of your taxes. You can take off depreciation out of your business income, and that affects how much income is taxable. Sales, you know, you sell something and you make a profit or a loss, that affects how much is going to be on your tax return. That's why we have to do this now. So for those that are fairly new with it, don't get discouraged. It's coming along. You have to work with this material. So this is what I want to emphasize in your reading. Before we began today, sessions 1 through 3, that covered your reading units 1 through 5, okay? So to get caught up, you're going to have to read 1 through 5 and watch the first 3 sessions. Session 3 is not on there yet. He hasn't downloaded that yet unless he got it downloaded while we were working on this session. Now, today when we started, we really needed you to have read units 6 through 8. Unit 6 covered just pretty much what we covered today. I think 7, I've forgotten exactly, guys. I think maybe 7 covered depreciation.
Yeah, it does.
So okay, and then 8 will cover capital gains and losses and so on. So what I really want you guys to do is over the weekend, please go ahead and make sure to read chapters or units 6 through 8, and then be ready for our session for our next session. Okay. So before we call it a day, does anyone have any questions they would like to ask right now? Want to cover anything that maybe you need clarification on?
Yeah, I have a question. So
Okay.
the other day, I was looking up the webs and looking at the book stuff and all that.
Uh-huh.
And it says before June 30th, the test is based on 2017.
Yeah.
But after June 30th, it's 2018. But the book that we have, the chapters that we have, still have the personal exemptions.
Right.
In 2017. So are we going to get new ones to study? How does that work?
Tell you the truth, no. That's how we were able to do this and keep this at absorb. The company was able to absorb low cost because we're using older material, slightly older. That's why as I'm going through this part of it, I'm trying to teach it based on 2018 material, but there is some stuff that's a little bit outdated. I'm going to, as I notice, I haven't even discussed things like personal exemptions or deductions. As we get into it, you're going to see that I'm using 2018 material. Okay. So now do keep in mind, if you want to, you could go to this same company and just purchase your own copy of it. We were just trying to save you money. Also keep in mind, we'd really like you to pay that $25 a month to buy into this, and then you'll have access to all of this additional info. Okay.
Yeah, I did. I signed up for that.
Oh, good. No, I think that's really wise. No, well, really, tell you the truth, the biggest benefit to you guys more than anything is just that big question bank. That's really where that's going to help you. Because keep in mind, I can lecture all day, but that's not how you're going to learn. This is just to help you give the structure. You've got to read, you got to interact, with the material through this way, and then you got to start interacting with the data or the information that I'm giving you by doing questions. And by the way, guys, at the end of each unit, end of each chapter, there's a little mini quiz, usually around 10 to 20 questions. Make sure to do those. Those are helpful too. But those of you that have bought into it, there's additional questions also that you can jump into, and I'd highly encourage you to use that. So keep in mind, I know there's a lot of information coming at you really fast. I also want to let you know that we're going really fast. The information we're covering now is mostly the same information that those of you that are already preparers covered in the 80-hour basic course. But we took 10 weeks to go through the basic tax preparation course, the 80-hour course. We're doing this in 4. That's why everything's speeded up here. But why are we doing that? Let me tell you the truth. The truth of the matter is most of the people on this course have been through this material before somewhere else. There are a few that haven't. The ones that have not, don't get stressed out. Take a little extra time. It's okay if you get a little bit behind from our presentation. It's all going to be available to you online. Go at the speed you need to go to understand it and be able to pass the test. Those of you, though, that do understand it can go through it and not have to and not have to necessarily catch every little detail that I'm covering here, because you already know a lot of it. So that's why when we get into part 2, we're going to slow down. Part 2, it's more complicated material, but we're going to do it over 8 weeks. In other words, over 2 months rather than 1 month. So this is pushed a little bit faster than what I would normally do if I had a little more time to work on it. But everyone, keep in mind, this is nothing to stress out on. If you decide you need a little more time to work with the material, you take it. You don't have to do things on the timeline we're presenting it, because it's all going to be available online to you. Okay? All right, so I kind of rambled there. Sorry about that. Did I answer your question?
Yeah, I just thought maybe if I just copied it and then crossed out some stuff and.
No, you can. I've done that. I've done that on stuff. But I'm going to be, like I said, when I get into some of those major changes, I'm going to be actually discussing the 2018 laws as we get into them. We just really haven't touched on that. Mostly what we're touching on is the same from previous years for the most part. Okay.
And that was basically my question. If you're gonna do 2017 or 2000.
Yeah, you know, if we had purchased updated books, it would have been so expensive that they probably would not have approved it the way we did it. You can always buy it yourself, though, if you want to do that. That's fine. The chapters would be the same, so you could actually do that. And you know what, Lisa? I have not seen this purchased thing. You might even look on there and tell me if you have access to the book on there. I don't know if you do or not.
No, I don't have access to the book, but I have access to webinars of
Right.
the chapters.
Right, right. We knew you'd have access to that and the questions. We just weren't sure if you'd have access to the new book. So we're just going to have to use the old book. It saves us all a lot of money. And be honest with you, the changes are, there's some significant changes, but the significant changes for part 1, I'll point out to you. The insignificant changes, I mean, let me rephrase that. The not insignificant changes, the changes I'll point out to you, the big ones, the small ones that are not major, I'm not going to worry about. And then and then keep in mind, though, 90% of this material has not changed. They haven't changed the definition of basis or how you calculated it, for example. Those are all the same. Okay. All right, and great questions. Any other questions or comments, guys, before we call it a day? I guess not. In that case, everyone, have a great day, and I will see you bright and early Monday morning.
Bye, everybody.
Bye, everyone.
Bye.
Bye-bye.
Bye.